Imagine you see a stock going up 10%, 20%, 50%. Everyone around you is talking about it. Your friends own it. YouTube is full of videos about it. Social media says it is the next multi-bagger. Suddenly you start thinking, maybe I should invest in it too. You may not be investing because you have analyzed the company. You may be investing because everyone else is. That's called herd mentality. Herd mentality is an action or decision of a large group of people instead of making your own independent judgment. In investing, it looks like stock goes up, people notice, people buy. Price rises, more people notice, and even more people buy it. Excitement increases, and you start thinking this stock can only go up. And eventually, fundamentals become secondary to popularity. Why does herd mentality happen? There can be many psychological reasons. Fear of missing out, FOMO. You see someone making money, you don't want to miss your chance. Social proof. You think if thousands of people are buying, they must know something I don't. Fear of being wrong. It's psychologically easier to be wrong with everyone else than to be wrong alone. Recency bias. If the stock has gone up for 6 months, you start believing it will keep going up. But the past isn't a guarantee of the future. Think about stocks that have become extremely popular. They start trending, then retail investors enter. News channel discuss it, YouTube creators discuss it, Telegram and WhatsApp group discuss it. Search interest explodes. The stock rises further. Now you aren't asking what is this business worth. You are asking how high can this stock go. That's a dangerous shift. The conversation has moved from value to price. Herd mentality works in both directions. Herd mentality isn't only about buying, it happens in crashes too. Imagine a stock falls from 1000 to 800 to 600. People panic, news becomes negative. You start selling, you say get out. You start selling because everyone else is selling. Price falls further. But what if the underlying business is still fundamentally strong? The herd may be creating an opportunity. This is where independent thinking becomes valuable. I have built my investment philosophy thinking independently rather than simply following the crowd. Be fearful when others are greedy and greedy when others are fearful. The principle is simple. When everyone is optimistic, you be cautious. When everyone is extremely pessimistic, you search for an opportunity. This does not mean automatically doing the opposite of what everyone else is. That's another mistake. You don't buy a bad company because everyone else is selling it. You investigate first. The crowd versus business test. When you feel an urge to buy a stock because everyone else is buying, ask, would I buy this stock if nobody was talking about it? Can I explain how the company makes money? What is the intrinsic value? What am I paying compared with that value? What could permanently damage the business? Would I still own if the market closed for 5 years? If you can't answer these questions, you may be following the herd. The 24-hour rule. Here's a simple technique. When you feel I have to buy this stock right now, don't buy immediately. Give yourself 24 hours. During the 24 hours, read the company's annual report. Look at the date. Look at the earnings. Check valuation. Understand the business. Write down why you are buying. If your thesis survives, you can make a more rational decision. If the excitement disappears, you may be experiencing FOMO. Independent thinking doesn't mean contrarian thinking. This distinction is extremely important. Following the crowd, everyone is buying, so I'll buy. Independent thinking is everyone is buying. Let me analyze the business and decide for myself. That's the mindset you want. You don't need to agree with the crowd. And you don't need to disagree with the crowd also. You need to think independently. The stock market rewards independent thinking, punishes blind imitation. When everyone is excited, don't become excited automatically. When everyone is scared, don't become scared automatically. Step back, look at the business, look at the valuation, look at the numbers, look at the risk, and then make your decision. Because the crowd knows the price. Your job is to understand the value.